For the next session, we have a globally renowned luminary, Mr. Philip Huber, a fellow CFA charter holder, Chief Investment Officer of Savant Wealth Management. To moderate this session, we have Ajit Menon, CEO of PGIM India Asset Management. The topic for this session is the allocator's edge, challenging the conventional wisdom of portfolio construction by embracing the alternative investment and strategies landscape. So may I invite the moderator for the session, Mr. Ajit Menon. Before I hand over to Mr. Menon, just a brief bio. Mr. Menon is the CEO at PGIM India Mutual Fund. He is the Chief Executive Officer, and as CEO, he oversees all aspects of the asset management business, including mutual fund and portfolio management services. Ajit is responsible for the direction of the business and its growth strategy. As a dynamic and result-oriented leader, he brings to the table keen analysis, insights, and a team approach to drive organizational improvement and implementation of best practices. Ajit has spent over 15 years with DSP BlackRock, where he played a key role in the growth of the business. He is associated with key industry bodies and is a sought-after speaker at various forums and conferences. He has authored papers on matters pertaining to the AMC business, co-designed a 6-month certification course in wealth management, and a 2-month retirement readiness certification course for business partners. Mr. Menon, the screen is all yours.
Thank you, Kishore. Thank you for that very kind introduction. And let me start by thanking CFA Society, Navneet, Anil, and Lynn Harshad, and the entire events team for bringing this fantastic program for our audience today. And welcome to the audience as well to the 6th India Wealth Management Conference, Challenging the Conventional. And I have the absolute pleasure of introducing Philip Huber, for today's session, the allocator's edge. And if there is anything about challenging the conventional that we should all be putting our focus around, it is probably going to be this session with Phil. Let me introduce Phil to the audience. Phil is currently the Chief Investment Officer of Savant Wealth Management, and he's been associated with the financial services world since 2007. Prior to that, Phil has been working at global asset management companies where he's worked with advisors in constructing portfolios and other investment strategies for their clients. Phil has earned his bachelor's degree from Indiana University's Kelley School of Business, and he is also a member of the CFA Society of Chicago. Phil has been featured in many notable media outlets, and this includes the Wall Street Journal, the New York Times, the Wire RIA Magazine, as well as Bloomberg TV. And most importantly, in 2018 and 2019, Phil was named as one of Investopedia's top financial advisors. I know that he and his wife, Christy and Hannah, live in Chicago, and they have a lot of interest. And I was quite intrigued with being a lifelong and diehard professional wrestling fan. Phil, welcome to today's session. And just for the audience, let me lay out how we're going to go about this. I'm going to invite Phil to speak for 7 or 10 minutes to lay out the context around alternatives and his book, The Allocator's Edge. Post which, what we thought would be best would be for us to have a fireside chat where I've had a sneak preview to some chapters of the book that Phil, is going to be launching in October. It's definitely a book to get hold of as and when it comes out. But I'll ask Phil a few questions. I think that will fill up our time. And of course, we'll take questions from the audience as well. With that, Phil, over to you. We'd love to have your perspective on the book, The Allocator's Edge, as well as your comments on this subject for all of us.
Sure. Well, thank you very much for the warm introduction, Ajit, and a big thank you to the CFA Society of India for inviting me here today and welcoming me. I really appreciate it, and it's a great honor to be here. So maybe a good place to start would just be to give a little kind of backstory and context around why I wrote this book in the first place, The Allocator's Edge, and that's certainly the focus topic of today's discussion. So I thought that might be warranted. So, when I first got into just the act of writing, it really was about 5.5 years ago, maybe, when I launched an investing blog. And that was really on the heels of becoming, fans of folks here in the U.S. of people like Josh Brown and Morgan Housel and Ben Carlson and the like, who had become very prolific bloggers in their own right. And I thought, why not throw my hat into the ring and start my own blog? And so I was already doing a lot of internal written communication for clients of my firm, and it was something I enjoyed as a creative outlet to the act of writing. So I began writing the blog for a year or two, and it started to develop a little traction. And with that, I got a introductory email from a publisher who I am now launching the book with, which is Harriman House. And really, they just wanted to get an indication of my interest in writing a book. And it wasn't something I was actively thinking about doing at the time. It was something I had always kind of dreamed of doing one day. And being an avid investment book reader and collector, I was very flattered at having the opportunity to do so. So then the question became, well, I really want to do this. Well, what the heck should I write about? And so I thought about different topics, and we bounced around a few ideas. And really what we landed on was, something that was kind of based on something I had seen, a Venn diagram that, if anyone's familiar with David Perel, he's a writing instructor, but he kind of thinks of this Venn diagram of what you should write about should be at the intersection of what you know, what interests you, and what you know, what excites you, and what people want. And so when I thought about where I had been spending the bulk of my time internally at my firm, it was researching and evaluating alternative investments. It was a huge passion area of mine. It was something that I saw firsthand that not only clients of our firm, but also our advisors were having trouble or challenges when it came to implementation and communication around how to best use them and how to properly set expectations. And so while they sounded great in theory in terms of adding them to a portfolio, in practice, it was a much more challenging endeavor than perhaps we expected. And so I thought there was a great opportunity where I realized that there's a lot of financial professionals and advisors and wealth managers who really truly want to, be on the cutting edge and build the best portfolios they possibly can for their clients. But perhaps they, and they also understand the challenges that are confronting traditional portfolios. And when I say traditional portfolio, I mean kind of that classic 60-40 stock bond mix that's become so sort of ubiquitous, particularly here in the U.S., which, I think might be challenged, quite a bit in years ahead, based, really on the math of low starting yields for the bond portion, historically low yields, as well as elevated equity valuations, particularly for the U.S. stock market. And so while that's been a very great type of portfolio to own for the last few decades, there's just a number of factors contributing to why that might be, facing an uphill battle in years ahead. So I think, while there is a strong case for alternatives, a lot of advisors have struggled. Maybe they've had a bad experience in their past where they've used alternatives, but it hasn't gone very well, or they maybe didn't have the right expectations in mind, or maybe their clients had improper expectations. So really what I wanted to solve for with the book was to try to kind of close that education gap, not just with advisors and investment professionals, but also with the clients that we work with, where we really try to inspire confidence and courage to kind of move beyond 60-40 and build better portfolios by understanding really, more deeply the why, the what, and the how behind using alternative investments in portfolios. So, that's how the book is structured. It's kind of structured in 3 parts along that framework of why, what, and how. And when I think of why alternatives, it's kind of back to that point that I mentioned earlier of not just the starting point of where we are today with low yields and high stock valuations, because that always won't be the case. At some points, in the future, rates, may normalize more for bonds, and equity valuations may be more reasonable for stocks. So it's not necessarily a market timing type of argument, but it is something I think we need to be cognizant of in the decades ahead, that starting points matter, and the starting point today for 60-40, indicates that we should probably expect, lower returns than we've had in the prior decade, and perhaps more realized volatility. Second to that kind of why piece is just why change portfolios at all at any point. And when I think about how much portfolios have evolved over the past few decades, you think of all the different innovations that we've seen, the growth of index and passive investing, the rise of ETFs, the adoption of the endowment model for institutions. So portfolios today look a lot different than they do 10 years ago and 20 years ago and 30 years ago. So that's just something that we should expect continually over time, is that our understanding of markets and risk and return will evolve. The democratization of certain asset classes that maybe at certain points are really exclusive to large institutional investors, at various points, thanks to technology and innovation in the world of finance, can become much more broadly accessible to a wider range of investor types. And so I think that piece is really just more, not necessarily due to the market environment we're in, but just a function of this is how markets have evolved over time. So we should expect a broader toolkit at our disposal in the future. So if we move on from the why is it important to move beyond 60-40 type portfolios into the future, what are the types of things that we should be looking at? What's the spectrum of alternatives? And the tough thing with a word like alternatives is it's a very loaded word. It comes with a lot of different interpretations, and that's really because alternatives tells you a lot more about what something isn't as opposed to what it is. And by which I mean, really, alternatives just tells you it's just not stocks or bonds. And so that is a very vast universe of different asset classes and investment strategies that ultimately, a lot of them have nothing to do with one another. So to kind of throw them all together into one bucket, I think the way we categorize it can be, in some ways doing investors a disservice, because there's a lot more nuance under the hood when you start to evaluate the different risk profiles and return profiles and diversification characteristics of these different asset types. So the way I thought about, developing a framework for the universe of alternatives is really to go chronologically, to go past, present, future. And so when I think of the past of alternatives, it's really been what I kind of view as the four usual suspects that you tend to see in the institutional world, which is private equity, hedge funds, real estate, and kind of more broadly natural resources, or things like gold and commodities. Those have historically been kind of the key areas, I think, that most people tend to associate with alternatives. When you say the word alternatives, those are kind of the categories that come to mind. And I think the results in these four areas are sort of mixed in terms of whether or not they're appropriate for most high net worth or retail investors. And so without getting into the nuance of each, what I thought was then interesting was then to say, okay, well, what are the more modern types of alternatives that are becoming more democratized and accessible? And what was interesting to me was there's a lot of parallels between, the alternatives that are gaining popularity today and those that have been popular in years past. And if you kind of connect the dots between those areas, you tend to see some interesting dynamics where something like private equity, you see alongside that the growth of private credit. Something like hedge funds, or that tends to be historically more, alpha focused, you've seen the rise of what we call alternative risk premia, or more systematic types of hedge fund strategies that can be accessed more cheaply, and really kind of taking what was once alpha and has now become more of a beta, but can be accessed more in more liquid structures and more, cheaper expenses and more transparent formats. Something like real estate is really just something within a broader category of what we would deem to be real assets. But outside of real estate, there are other types of real assets, such as infrastructure and farmland and timberland, that we think have complementary characteristics to real estate in terms of their ability to provide diversification and inflation sensitivity and yield to a portfolio. And then lastly, something like gold may now see the rise of a digital asset like Bitcoin that has gained the moniker as digital gold. So you tend to see some parallels and commonalities from the alternatives of years past and those that we see today and into the future. And so that's really the progression of part 2 of the book. And then really where I wanted to tie things together with part 3 was what I think is probably the most important part. Is it's one thing to understand the case for alternatives and the inner workings of the different types of alternatives, but really where the rubber meets the road is how do professional investors and allocators combine these things together into a portfolio how do we think about the different nuts and bolts, and how do we vary the sizing of those alternatives allocations and the components within them based on the objectives and goals of the underlying investor, and what are the different trade-offs that we have to consider when we're doing that. And then I think, probably the most important piece, and this is where I finish the book, is this idea of communication, and that at the end of the day, and this is a great quote from Cliff Asness, is the good portfolio that the investor can stick with is far superior to the great portfolio that they can't stick with. And what I mean is, a portfolio that looks a lot different than your peers is inherently going to be probably more difficult to hang on to at times, because the more components you have in the portfolio, the more likely it is at a given point in time, something's going to be performing differently. Sometimes you're going to have something that sticks out and not in a good way. And so it might be, tough to hang on to things when they seem like they're not adding value to a portfolio, even if we have conviction that they might add value longer term. And so I think the more, advisors and allocators can be comfortable communicating these strategies effectively, setting proper expectations, trying to make the unfamiliar familiar, I think that can go a long way into creating a successful investment experience. And at the end of the day, that's really what it's all about, is the investor experience is just as important as the underlying investments that they're in itself. That's broadly what I'm trying to achieve with the book, and really excited to deliver it later this fall. So I think that's probably a good summary for now, and I look forward to moving on to the Q&A portion here with Ajit to dive into more detail.
Thank you, Phil. That gave us a good overview on the book, and I would encourage every practitioner or audience member here interested in alternates that this book that Phil has written and should be out in October is like a handbook on alternates, and it should be recommended reading. I want to dive in to some aspects of that book, Phil, which I managed to go through in a very limited time. And I want to start with asking you that, this whole narrative today of very rich equity valuations and maybe a lower for longer rates scenario is something of a challenge that is well written about and well known by, most people. But as you write in the book, there is a point where we have to stop admiring that problem and start doing something about it. What's your recommendation as to, what's the starting point?
Sure. So I guess the first thing I'll say is I am by no means the first person to make, the observation of the low expected returns of 60/40 portfolios. This has been going on for several years now. And so there's nothing really novel about the observation. And I think what's a bit challenging is, if you were making this suggestion 5 or 6 years ago, and then you fast forward 5 or 6 years, well, what's happened? Rates have gone lower, which has continued to bode well for the bond piece of a 60/40 portfolio. Equities have continued to do well, largely just through rising multiples. And so the challenge for allocators is they hear this a lot, that 60/40 is going to be challenged, 60/40 is going to be challenged, but it's continued to do quite well for them and for their clients. And so it's understandable that there's a hesitation to move off of that, and a bit of a complacency. Well, but the hard part is that those factors that were contributing to lower expected returns, those aren't necessarily market timing signals, but at the same time, the more expensive stocks get, the lower yields get on bonds. That only makes the math more challenging to overcome and creates an even larger hurdle in the future. So I think the way, the hard part about addressing that is it is a very comfortable thing. It's a very easy portfolio to implement. It's very intuitive to most clients. Oh, I've got my stocks for growth and I've got my bonds for income and diversification. Why do I need more than that? I can allocate to that type of portfolio with a few clicks of a button, maybe one or two funds or 3 funds. It's a very simple and easy portfolio to do. And I think in today's world, where those are certainly popular tenets of portfolio construction, which is low cost and passive and all those things, which I think have a great role in a portfolio. I think what's important is that we tend to have short memories in investors. The last decade plus, the entire 2010s, that was a period where we saw abnormally high returns for 60/40 relative to history and below average risk relative to history. And that is not a dynamic that can continue indefinitely. At some point, there will be some mean reversion take hold. where you see rising volatility, lower returns. And so I think we need to be careful about how short our memories can be. We only need to look back to the decade of the 2000s to see that we had a lost decade for U.S. stocks. The S&P 500 had a negative return over that full decade. That was, if you weren't diversified for that decade, you had a very poor experience. Whereas if you had, even within the stock allocation, exposure to international stocks and small cap stocks and value stocks, you at least delivered a positive return. So I think as we translate that to alternatives, we need to have a good sense of what lies ahead. And this is not a macro forecast. I'm not trying to be a doomsayer by any means. And I certainly don't want to come across as saying that the 40% to bonds has no place and then it should go from 40 down to 0. I don't think that's realistic either. But at the same time, I think we need to understand that bonds, even though in the past 20, 30 years, they've served in a negative correlation function to stocks, and that's provided good diversification. That relationship is not set in stone. There have been historical periods where we have seen positive correlation between stocks and bonds and seen both asset classes go down at the same time. It doesn't happen often, but it can happen. And usually the culprit, reason behind that is something like high and rising inflation. And again, not that I'm predicting hyperinflation or a repeat of what we saw in the US in the 1970s, but I think we have to be mindful that materially higher inflation relative to what we've seen in recent years is a bigger risk today than it was in a couple of years ago. So that tends to be the what I would call the kryptonite for stock bond portfolios is a inflationary period. And so I think investors need to be mindful of ways to augment a traditional stock bond mix by incorporating some subset of alternative investments in a material way, not just, hey, here's 2% in the portfolio and alternatives just to kind of check a box and say, okay, now I've got alternatives. I think it has to be substantial and material. That number may vary client to client. There's no right or wrong answer, but I guess my general guidance there is it's got to be enough to matter, but not too high that you risk what I mentioned earlier is making that portfolio too tough to stick with over time.
Great, Phil. And I know that one of your favorite quotes around diversification is that diversification is a regret maximizing strategy, as Jason Yu said. And as you diversify out of a 60-40 traditional portfolio, and I know that many customers would already have exposure to real estate, gold, and at the higher end, at the ultra high net worth, also to private equity and through the alternative investment fund structure here in India, exposure to other strategies as well. What I want to ask you is this, two questions rolled into one. When you think of an overall portfolio beyond a 60-40 to include alternates, is there some sort of thumb rule that you would recommend customers? Is there something in your part of the world which says that this is what would typically be the proportion of a portfolio beyond the 60-40, which includes alternates? That's question number one. And question number two is, when we think about adding alternates to the portfolio, it's obviously to meet a certain underlying need of the customer. So when you think about institutional clients or high net worth clients or retail clients, what kind of goals do alternates really help fulfill?
Yeah, and I think those two questions really go hand in hand with one another, in that the nice part, the fun part about my job and the company I work with is that we work with investors across the investing life cycle. We have clients in their 20s and 30s who are accumulating assets and have multiple decades until they retire. And then we have, people, approaching or well into retirement. And so there's a variety of different investor objectives and goals that we have to build and design portfolios to suit. And so, again, that's why there is really no one size fits all recommendation to alternatives. What I would preface that with is what we tend to see is usually in the neighborhood of 10 to 30% is where we see. But in terms of, we also have, again, in full transparency, we have clients that have zero allocation of alternatives because for some people, it's not appropriate. They're just trade-offs that don't make sense for them. And so, we don't blindly say everybody has to have alternatives. We feel strongly that the majority of our clients should have material allocation. It tends to, fall in between that 10 to 30% range. But to your second question, thinking about what are the different types of objectives where we start to not just weigh the size of the alternatives bucket, but also the components within it. I like to use the acronym DIY. So, a lot of people think of DIY, the acronym, do it yourself. For me, DIY is diversification, inflation, and yield. And so we think of, why are we adding alternatives to a portfolio? Well, I think it's to potentially fill in gaps where stocks and or bonds might fall short. And so when I think of diversification, again, bonds have been a good diversifier historically to stocks. That's not always the case. And even if they continue to be a good diversifier to stocks, I like to say diversification is the only free lunch in investing. So you want to eat a lot of it if you can.
Yes.
So there's just a benefit, in my opinion, to having a variety of different exposures and risk factors in a portfolio that are uncorrelated to one another. So that's the D. The inflation piece, that, as I mentioned earlier, is probably the type of macro environment that could be really, really challenging for a stock bond, 60-40 type portfolio. So thinking of things like real estate or commodities or gold or other types of real assets, those can be complementary to a stock bond allocation for an investor who is susceptible or concerned about higher and rising inflation. And then lastly, and this is a pretty universal problem across the world now, is just rates are low across the globe. The hunt for yield is very prevalent. Investors need reliable sources of income to support multi-decade retirement periods. And with the U.S. Treasury tenure in the low ones, that's not something that longer term can be counted upon to deliver that type of income stream that folks need. And so being open-minded to different types of non-traditional income strategies, I think is going to become more important for a lot of clients as well. Again, it's never a free lunch. With higher yield comes higher risk, and so that's something I think that allocators need to be mindful of. Is we can be lulled at high yields. They can certainly be alluring to look at, but we want to be mindful of there tends to be high and rising higher correlation with risk assets, the higher yield you have. So I think that informs where you put something in a portfolio, how you size it, because as you've mentioned, diversification isn't always necessarily there. For some asset classes it can be if there's really kind of a structural non-correlation, but there's also certain asset classes that might be modestly or low correlation most of the time, but when there's chaos in the world or a big global event, those correlations might spike. So I think that's something that allocators need to factor in when they're sizing and allocating to different asset classes.
That's right, Phil. And as you mentioned an acronym of DIY, let me also pick up another acronym that I saw in the book from Cliff Asness of AQR, and he talks about financial LSD. And which is like a bad word, leverage, shorting, and derivatives. And you have, Warren Buffett talks about derivatives being instruments of mass destruction. My question really to you is that when it comes to alternatives, and you move away from just looking at what you call diet alts, which is simply the real estate or gold and those kind of alternative assets to an equity bond portfolio. Mostly for people and advisors, alternates seem like a black box, illiquid, dangerous. So when you're communicating to customers or practitioners communicate to customers, what's the best way to bring perspective and expectations around alternatives?
Yeah, so I think starting with the acronym you mentioned, and so the LSD that Cliff refers to is not the hallucinogenic drug, but he's referring to those what they call the three dirty words of finance: leverage, shorting, and derivatives. And I think those are tools that can be used responsibly and to deliver value, and they can also be used irresponsibly. And when I think of those three areas, I think of the quote from Spider-Man, with great power comes great responsibility. And so, but when we think of the leverage and shorting and derivatives, these are tools that aren't necessarily as foreign as most people think they are. You know, something like leverage, like anyone who's taken out a mortgage to buy a home, you're using leverage. You know, derivatives are used by corporations across the globe to manage, you know, and hedge price risk around commodities or currency, movements. Something like shorting, like I think short sellers get a bad rap sometimes in the media, but a lot of the big, financial frauds in the world have been uncovered by short sellers. So I think, again, I think it's too much of an oversimplification to label any of those three as good or bad. I think they can be used very well and responsibly to again, incorporate a certain type of alternative strategy and to manage risk, but at the same time, they can be used irresponsibly too. So I think, we have to look at these things with, prudence and use them in moderation, but when used in that way, they can be valuable to extract certain types of risk premiums or to essentially deliver exposures that couldn't otherwise be delivered without them. So not all alternatives have meaningful, usage of leverage, shorting, and/or derivatives, but a lot of strategies do. You mentioned the other term I use in the book, which is I call diet alts. The reason I call them diet alts is they kind of sit between traditional and alternative, and I think that's another, interesting dynamic that we see. Again, alternatives is just a word, and to me, all that means is something that isn't mainstream yet. Certain alternatives may never become mainstream, but when I think of what I view as diet alts, those are things that are probably a little bit less complex to the average person. And so they're more palatable and easier to understand. And when I look at things like real estate, gold, commodities, emerging markets, inflation-linked bonds, those are things that I think are just, again, and the reason that I call them diet alts is if you look at, portfolios, for not just in the US, but in different countries as well, those are pretty common allocations that you see, common, static allocations in investor portfolios. And so to many people, those are no longer even alternatives. High yield credit would be another example that when that became an asset class in the 80s, that was very new at the time. And so for many people, it was alternative. Same goes for emerging markets equity allocations. Not everybody had a dedicated EM allocation 20 years ago. Now it's pretty much the standard. So I think we'll probably see that same dynamic take place with certain things that are, viewed perhaps more skeptically today because they're just not as prevalent. But I think in 10, 20 years, things like long short equity might be considered more of a traditional type of asset holding as opposed to an alternative. So that's something I'm always kind of paying attention to, and I think is just a natural byproduct of time passing and things that more and more people that they deem valuable in a portfolio. As it becomes more mainstream, it sort of sheds that that view as being an alternative and just becomes more of a commonly held asset.
Right, and I think that's great perspective, Phil, because while we are here discussing the A word, it almost gives it a bad name. However, what you're really saying is that at some point in time, some products were considered alternates in a different era, and now they are more mainstream. And so when we approach what is available as alternatives in the markets today, some of them are going to be mainstream probably, 5 or 10 years from now, and some others wouldn't. One of the most interesting things that I came across in your book, Phil, was that you really clearly laid out the history of financial innovation, starting with, with Harry Markowitz and William Sharpe and, Eugene Fama and so on and so forth. And what I would want you to really comment on is if you could take the audience through what you think is sort of the big milestones that we've been through in financial innovation in terms of products, for the advisor. I mean, if you were to just look at an advisor's toolkit and you were to look at what's the cutting edge science giving you today as an opportunity, how has that developed and how that can give more confidence for practitioners and advisors to bring alternates to their clients?
Yeah, I mean, I think it starts as far back as just the advent of modern portfolio theory and this notion that risk and return are related and that diversification is a valuable thing in a portfolio. And then when you think of the early 90s and the French research on small and value and those being factors that explain a lot of the variability of equity returns, that has since been expanded upon quite a bit. And now we have things like momentum and quality and low volatility as other targeted factors that equity portfolios are targeting. And so I think a good way to think of it was, Morningstar. Everybody's familiar with the ubiquitous Morningstar style box, a two-dimensional, 9-grid box that's large, mid, small, and value blend growth. And that was for many years the way that investors kind of looked at equity portfolios and tried to figure out how they want to tilt and what types of funds they wanted to own in different categories. And that was a very influential sort of thing. And then now we moved from two-dimensional to, I would say, more three-dimensional today, where more and more factor research has been done, and I think more and more allocators and advisors are viewing things through a factor lens, not just in equities but in multi-asset portfolios. And so now Morningstar has a factor profile tool that still shows you where a fund plots for size and value versus growth, but also how does it score on liquidity and momentum and yield and quality and volatility. And so I think we've expanded the toolkit there. You see similar evolutions happening within fixed income and in alternatives. And so I think really just this adoption of a risk factor framework and analysis way of doing things versus more of a asset class way of building portfolios. And I think it's good to look at things through both lenses, but I think having more than one vantage point is helpful. And I think of, again, what just the technology just making things easier and more broadly accessible is just a trend that we see in all aspects of our lives, not just finance and investing, but everywhere. Is technology improves, things get easier, things get faster. And so I think, again, like the idea of going, like, with 2 clicks of a button, I could own the entire global stock and bond marketplace with 1 or 2 funds or ETFs. That wasn't the case when I was born or 40, 50 years ago. The idea of, if you were to take a time machine back and tell someone in the 1950s, hey, you should just own all 5,000 stocks across the globe and 1,000 different bonds across corporates and governments and mortgages, like they would look at you like you had 2 heads, because that wasn't something that people could do effectively at the time because the costs were so prohibitive. And so I think that sort of technological advancement bodes well for things like alternatives that, again, are more costly to implement, a bit more inaccessible. And so I think it's only going to democratize some of these areas the more we advance there. And then I think another analogy that I like to use when I think of a current trend in investing, at least here in the US, is something called direct indexing or custom indexing, which is a natural sort of extension of index investing. And I sort of use this analogy in the book to compare the path to getting to direct indexing from just active management decades ago. There's a similar trajectory for asset allocation. So if you think back to the direct indexing analogy, actively managed funds were the way to get market access and market exposure for investors 20, 30 years ago. And then the index fund came around and it solved for things like lower cost, broader diversification, better tax efficiency. And so it checked those boxes, and that obviously led to a huge growth in that part of the market. And then when you think of, okay, well, what are the things where maybe index funds fall short on? Well, it's the ability to customize a portfolio. When you're buying a packaged product, there's certain things you're kind of taking that product as is, whereas a direct index is you're owning the underlying securities directly. So you're still getting the same benefits of indexing, but you're also retaining the ability to do more granular tax management or to exclude certain securities or industries that maybe you don't feel strongly about holding for whether it be ESG related reasons or maybe you work in finance and don't want to have overexposure to financial stocks or, any number of reasons. So I think that's a trend we're seeing in equity portfolios is this kind of, path towards customized allocations that's been made possible through innovation and technology. So now we take that to asset allocation and starting with the 60/40. Well, what has the 60/40 done really well? Well, it's been a very low cost, simple way to get static exposure to stocks and bonds, which are great, portfolio building blocks for every investor. So what are some historical attempts at improving upon 60/40? And knowing that each has flaws of their own, but each has brought something different to the table, I think of things like risk parity. Risk parity is an asset allocation technique that aims to still deliver, broad diversification, but to balance the risk. If you look at a 60/40 portfolio, 90% of the risk contribution comes from the stock side. So a risk parity approach also incorporates things like commodities and tries to, modestly use leverage so that each asset class is contributing equal to the risk of the portfolio. So to me, that's an advancement in building portfolios that is, gained traction. Another tool or technique is something called global tactical asset allocation, or GTAA, where it's, essentially a broader opportunity set of securities and asset classes and more of a dynamic allocation as opposed to static, and more, dynamic risk management using things like valuation and momentum and trend following as ways to figure out how to, increase or decrease allocation targets. And then something called the Endowment Model, which obviously, as the name implies, very popular with endowments, popularized by, the late David Swensen at Yale, and adapted, I would say, across other institutional formats as well, whether it be pensions or foundations or other types of institutional investors, where it's take advantage of a long-term horizon of an entity or an institution, incorporate uncorrelated assets, return streams, and take advantage of an illiquidity premium because of that long time horizon. So those are all different attempts at building upon and improving, traditional balanced asset allocation. Not all of them is perfect. They each bring something different to the table. But when I think of kind of the portfolios of the future that advisors and wealth managers are going to be building for clients, I think they're going to be adopting elements of each of those types of approaches. We don't have a name for it yet, but that's where I see the trend going is, taking what are the key benefits of these different types of portfolio construction methods and having a kind of best in class solution to deliver to wealth clients.
Lovely. I'm going to bring in some audience questions now, Phil, as we have about 10 to 13 minutes left. So I'm going to roll two questions into one. One was something that you partially talked about, which is different tools that are available for allocators and advisors. The specific question is, of course, around asset allocation tools that you would use at Savant for clients. I mean, if you could, name some of those tools. Maybe they're available only in your market, and very few probably here in India, but you could give us some idea of the kind of tools available, which are more, so broadly known. And the second is around costs and impact cost. When you think about portfolios, you spoke about indexing, which was one way to, take care of bringing costs down, for instance, in building a portfolio. As you add alternates, clearly there's going to be, a different impact of that. And how do you think through impact costs when you build alternates into a portfolio? So those two really, and I'll then move on to the next.
So the first question, in terms of like me and my team at Savant and the sort of research tools and analytical tools that we use, the primary two are Morningstar Direct and Y-Chart. Those are our two main analytical tools that we use. And then we supplement that through, because we have some strong relationships with different asset managers, occasionally we'll get access to their internal resources as well. An example might be something like BlackRock. They have their Aladdin, portfolio management or analysis tools, and so they can help us run analytics if we're trying to model out, different changes. So, so I would say it's leveraging those kind of in-house tools that we have, but also, working together with fund companies and asset managers that have their own tools and can help us with some of our due diligence efforts when we're kind of building and designing our portfolios. Sorry, can you repeat the second question?
In terms of the impact cost, Phil, how do you think through impact costs when you build alternatives into a portfolio? What should you be careful about?
Yeah, a big topic of the book is this idea of trade-offs, and adding alternatives to a portfolio introduces a lot of different trade-offs that investors need to weigh and consider to deem whether they're appropriate at all. At what size are they appropriate? And when I think of the three big ones that come to mind when it comes to adding alternatives is costs, liquidity, taxes. And so kind of going one by one, I'll start with cost because that was really what the question was focused on. Like if you're an investor who is, starting point is index funds and really only stocks, bonds, you likely have a very, very low cost portfolio. Adding in alternatives I feel comfortable saying this, it's going to make your portfolio expenses on average it's higher. That's just the nature of how alternatives work. And so I think that's a tough piece for a lot of people who are accustomed to rock bottom costs for portfolios is alternatives are inherently more expensive. Like the costs have come down and it's definitely category dependent. There's some categories that are, modestly, more expensive and others that are quite expensive. And so I think with anything in life, there's, we're always evaluating purchase decisions in our life. And some things we think we assign a higher value to and are willing to pay a premium for, other things we're not. And the same goes for investments where, there's no denying that costs matter quite a bit. Every penny that you're not paying out in costs, you're keeping in return. But at the same time, there's always a cost benefit trade-off that needs to be weighed. And so if we think of alternatives, if we think the additional diversification or additional return or additional risk reduction that we're getting from the addition of something, one or more alternatives, if we think though the incremental cost is outweighed by the net benefit, then that makes the trade-off, worth it. But it's certainly, you have to pay put a closer lens on costs when it comes to alternatives because the costs are higher naturally, and there's some products out there that are very, very high cost. And so I think you definitely want to, skew towards the lower end within categories, but it shouldn't be the only consideration. And by that, I mean the lowest, just because a fund is the lowest cost fund in a certain alternative category doesn't make it the best fund. There's definitely, attempts happening to sort of create mechanical index-based, trackers for different alternative strategies. But I think there's certain alternatives that require a bit more complex to implement. There's a higher risk of slippage costs when it comes to trading and execution. And so you don't necessarily want an index fund just because you can get one for certain alternatives because it might not deliver the best outcome for you. So I think costs are a very important thing, but they're not the only thing. And they shouldn't be looked at in a vacuum. It should be, what are the incremental benefits I'm getting in my portfolio, in light of the increased cost? And then how what are ways that I can evaluate the different costs involved? And then similarly for liquidity and taxes, taxes is just another form of cost. It's just something that the end investor doesn't keep. And so the way we try to be mindful of that at Savant, and I know that the tax laws here are going to be different than in India, but what we generally tend to see, I hate to generalize too much, is most alternatives tend to be less tax efficient than traditional asset classes. So the way we think about that is, in the US, there's a lot of different account types that investors have. Usually, when we work with clients, they have multiple accounts, they have taxable accounts, but they also have retirement accounts, IRAs, Roth IRAs, that all get different types of tax treatment. And so we just try to be very mindful of that when we're implementing portfolios. And if there's a certain asset class that is very tax inefficient, we'll typically try to attempt to locate that inside of a tax sheltered account type. So it's things like that where they can still be, owned. We just want to make sure that we're keeping as much of the return as we possibly can. And then on the liquidity piece, that's going to be really dependent on the client. Some clients have a great appetite for illiquidity and aren't going to need to tap into their portfolio very heavily for income needs or anything like that. And so they might have more of an inclination to own things like private equity or things like that have very long time horizons and really no liquidity. And then there's some folks that we work with that really they place a premium on having that liquidity. They like the optionality. They like the comfort of sleeping well at night, knowing that if they need to, they can tap into their portfolio. And so that's an exercise that our advisors engage with their end clients to try to get a sense of, where on that liquidity spectrum do they fit? How much can they tolerate? Because, if they can tolerate some illiquidity, that opens up the universe for us more to incorporate certain types of alternatives that unfortunately just aren't available or aren't useful in a daily liquid format. So those are the three big trade-offs that come to mind: is cost, liquidity, and taxes.
Right. Thank you, Phil. And, any conversation around alternates wouldn't be complete if we didn't discuss cryptos and NFTs. And that's been front and center across the world and here in India as well. So we do have a question about how you see cryptos and NFTs within alternates. Is it an alternate? I would pretty much say that yes, it is. But I think more importantly, if you could lay perspective around within alternates, when you look at sort of a risk reward spectrum or a step up of risk and reward, where would you put NFTs and cryptos? Some perspective and comments around from you to what you advise your clients on.
I would say, first of all, I would definitely bucket crypto as an alternative asset class. That it's in the book. There's a whole section on crypto in there.
Yes.
The interesting thing there is there's definitely a generational divide when it comes to how investors view things like Bitcoin and Ethereum and other crypto assets, where there's a younger generation, that has substantial parts of their portfolio in crypto, and to them, that's about as traditional as it comes. Like they have stocks and they've got a bunch of crypto, and they don't necessarily view that as an alternative. So I think, again, the word is in the eye of the beholder for sure. I think the reason I think of it as an alternative is just the nascency of the asset class itself. I mean, Bitcoin's only been around for, call it, 12, 13 years. Like, that's a very new asset. Like, we have, 12 years of history now of its performance and its diversification profile and all those things. But at the end of the day, like, 12 years is not a lot of time in the grand scheme of things. We've got data going back centuries on stocks and bonds. So I think we're, certainly still early innings on crypto. I think it's a bit of a nuanced view I have on crypto in terms of appropriateness. Personally, I think there's a role in a portfolio for them, and I personally own some crypto assets, but I don't think it's necessarily appropriate for everybody. The volatility in crypto is magnitudes higher than that of stocks, and I think perhaps much more than many clients that we work with can tolerate. And then there's also the question of how are you accessing crypto assets? Is it directly through an exchange or a wallet service? There's been attempts to build and deliver, crypto-focused funds here in the U.S. And so far, the many attempts at a Bitcoin ETF have yet to be approved. And so I think the challenge that advisors and wealth managers face, even if they feel, strongly about clients owning crypto, they don't necessarily have a great way to buy it for them and include it in the portfolio, just because some of the traded products here in the U.S. have some, I would say some flaws around them as it relates to fees and discounts, premiums that they can trade out to their net asset value. So, NFTs, I'm less, first of all, kind of less knowledgeable about NFTs, I would say, than kind of broader crypto. And I think that is even more nascent and uncertain. And I think, especially earlier this year, we saw some really high degrees of speculation and frothiness and kind of bubbly, type behavior in NFTs that has since kind of deflated quite a bit. So I think that's going to be the case. I think with NFTs, I think there can be some interesting applications long term, and I think there will be some true innovation that comes out of it. But I also think a lot of money is going to get lost by betting and speculating on some of these assets that really, again, have no true value and get priced at insanely high prices. So I would say I'm more pro things like Bitcoin and Ethereum, the ones that have been there the longest and have developed the most traction. In terms of some of the other kind of altcoins, I'm less certain about, from my perspective at least.
Thanks, Phil. I think we've got exactly 1 minute left, and after that we'll get into the breakout room. But I do have a question about volatility and the fact that traditional asset managers don't really use, volatility to its advantage, and would taking care of volatility, looking at long vol products and things like that become more important as you see it going forward. So if you think you can wrap that in about 30 seconds or so, I think we can at least answer that.
Yeah, I'll do my best. Yeah, the long story short is, no pun intended, is that, traditional portfolios tend to be, because they're so equity heavy, they tend to be short volatility. And so
Right.
when things blow up, they tend to lose money, and that's just the nature of their volatility profile. The challenge with things that are long volatility or structurally long volatility is they tend to do really well when volatility blows up, but over longer periods of time as a buy and hold investment, they have a negative expected return. And so you really have to get the timing like absolutely right. So I think that being said, I think there is room in a portfolio for asset classes that exhibit some level of convexity, and potentially get stronger as things get more volatile. But I would say I'm more of a fan or proponent of things like trend following and managed futures that has that kind of convex payoff profile where it tends to do best when things in traditional assets are at their worst, but it still has a positive expected return over longer periods of time. Whereas other types of kind of structurally long vol type assets, I think over time you're going to lose money there, and people are going to time them inappropriately. So hopefully that was within the 30 seconds you allotted me.
Thank you, Phil. That was an absolute pleasure. I know that for a subject like alternates, a whole day session would still be short, I guess. But thank you very much for bringing.
That's why it was so fun to write about. Is there's so many different avenues you can go down. That's what made, again, if I was going to devote a year or two of my life to writing a book on a subject, I wanted it to be something I really felt passionate about and interested in, and hopefully that's reflected in the book if you read it. And I
It is.
hope you do. And I thank you for your time today. I really appreciate it.
It is. Thank you, Phil. And I took the central message from your book as we can do better for our clients, and if we make that effort. I think in this changing world, this is one area and one subject that we can build, pretty well. And I know that your book is going to be a starting point for a lot of people. So thank you very much for today. And let me hand over back to Kishore.